Is this the beginning of the next market meltup? Market meltup? What is that? And what are the charts telling us? Stay tuned, we'll discuss this and much more. Hello, this is Michael Loftus for Wealth and Wisdom TV. If you have not already subscribed, please do so today. Also, we had a new video this weekend from our Weekend Wisdom series about how to prepare for the next crash. First up, the numbers. Green across the board. Looked pretty good again, but kind of sluggish last week. Not unexpected after the run we've had. So, first, question from our viewer. What is this whole market meltup thing I've been reading about? Well, here's a hodgepodge of articles. A lot out there this week. We've got some links below. But basically, if you look at the definition according to Investopedia, it's basically a dramatic and unexpected rise in performance, but basically it's a stampede mentality. Well, I don't really see that happening. I think one is volume. You look at last week on a Thursday, 5.8 million in trades. Year ago, 6.45. So we're not seeing a stampede. It also is not a dramatic rise. Yes, it's been a rise, but I wouldn't necessarily call it dramatic. So we'll continue to watch. Let's get to the big charts. First up, S&P. What are we seeing here? I think it's time for a pause. You look at the bottom, we've got momentum, a potential crossover. RSI relative strength, we've been overbought for a couple weeks, so I think it's time for a pause. Another good reason is this chart. When you look at this, here's each of our consolidations from the election last year. Consolidation 3%, consolidation 3%, etc. We consolidated, we broke out 3.29%. So pretty consistent with the last couple run-ups. So again, another reason why I see a consolidation. Here's our S&P weekly view. And here, what do we see? Not much different from last week. Momentum is still turning up, so long-term trend. Bias is definitely still to the upside. Relative strength, not really overbought, but a little bit. So again, short-term, maybe a pause. Mid-long term, still look very strong. Nasdaq, been talking about this the last couple weeks after the pullback. You had a good opportunity to get in if you weren't there. And we've had that confirmation. We've gone out to all-time highs once again. But, you know, a little bit of move there. You see at the bottom, momentum might be crossing over. Relative strength, not quite over 70 yet, which would mean overbought. But, you know, again, we've had a nice little run here in the last few weeks. So would not be surprised to see a pause at this time. Now, the breadth of the market here, we've got our highs minus lows, so new highs versus new lows divided by total issues. So when you look here, we've got each of the different markets above 10% is bullish, below 10% is bearish. Now, any change? Yeah, small and mids. We finally got above 10. We had a nice surge in both of those sectors. We're now below 10, but the rest of the market looks pretty strong. Moving averages, same thing. You've got each of these areas, small, mid, large, Nasdaq, above 70% above 200-day moving average. Strong. 50-day moving average, well, maybe not as good. You see small and mid turning down a little bit. Not surprising after a big run there. And you've got Nasdaq and S&P going sideways, which again gives me another thought of why we see this going sideways for a little bit. Next up, we have sector focus. Why do we focus so much on sectors? It's a big part of our portfolio. Depending on the client's risk, we're 10 to 20% on sectors only. And I got to tell you, it's a nice way to add alpha being returned to portfolios. Our sector part of our portfolio has done very well this year and continues to do well. So first up, utilities. Talked about this last week. There haven't been a lot of opportunities This was one of those, and I think it still is. So we talked about the setup, really looked good. The bullish flag just came out of that, and boom, up to the upside. So really see a nice upside here. What are the reasons? Well, it's far from overbought. Got room to run. Momentum's pulling up. Now at the bottom, why did this happen? So if you're looking, we are not day traders. We get in and we stay there for at least a quarter. But you look at a correlation. So correlation, right? If you're 100% correlated, then you're moving with the market, okay? Here, what's happened? Well, interest rates went down, utilities go up. So there was a definitive correlation there, and that's what I have at the bottom. Next one up is banks, just because I've been talking this for a while, and this definitely has a negative correlation. So when you look here, okay, still looks good. We had all-time highs, got a little bit overbought. We talked about that last week, expected a consolidation, and then we had treasuries go down last week. So here, a little bit different. Treasuries go down, okay, and banks are going with them. So positively correlated to treasury. That's a way you can find. So if you've missed it, I'd wait. I think we're going to continue. We'll talk about treasuries. There might be an opportunity down the road. Healthcare added this beginning of this quarter. Not much last week. Still a sideways consolidation. Not surprising with some of the news out there last week on defunding and getting rid of Obamacare. So still like healthcare, and we'll continue to stick with it. Treasuries. Haven't spoken about this in a while. A little bit surprising, but we kept on getting lower highs. Really good, right? Treasuries were down. And then we started shooting up unexpectedly. Really went up quite a bit. And 230 was your support resistance area. We broke down on Friday, 2.28. So we'll see what happens here. I think that a little bit interesting. I don't see a lot of reason except that the market's getting a little bit tired. You have an opportunity here. We also, some of the other bond markets, the German bond, etc. I mean, this is still the best play in the world. So you have some money coming in here. Now, Treasury spreads, 10-year minus the 2-year, 0.77. Pretty surprising, right? So the lower it goes, the worse it is for the market. So negative is really a problem. So 0.77 is not a big issue, but anything below 1 starts getting a little concerning. But I think it's too early to think about what the effect on the markets are here. Data, real quiet last week. Small biz index looked really good. As a small business owner, but I do see that from some of my clients. Consumer sentiment, highest read since 2004. Wow. Now, I could say that is a contrarian view, okay? Generally, when things get so euphoric, right, you got to be careful about that. So, a little bit interesting on that read. On the ISM, again, I think we talked about that last week, but what a great number, okay, and how we see that playing into the overall market and expansion, which is interesting to see. How about the individual investor, AAII? We actually had quite a bit of move on the bullish sentiment up to 39.8, okay, a little bit neutral. A little bit, those who went bullish got out of bearish. We lost about 5.6 points there. Still in that neutral mode is what I'm thinking at this point. But I found this chart last week to kind of add to this view. That's the AAII, how they feel about it, but what are consumers actually doing? Well, this is a TD Ameritrade. It shows you actual behavior, and they started pulling some money out of the market in the last week or so. Not surprising, hitting all-time highs. This week, fear and greed, down quite a bit from 92, a little more reasonable. Each of our indicators continue to remain positive. Our short-term went positive September 10, mid-term, long-term. So at this point, it's still all signs green, and the market looks for more upsides, potentially. Okay, but as always, especially at these levels, I always think it's a good time to stay nimble. So, as always, thank you so much for watching. Michael Loftus for Wealth and Wisdom TV.